Okay, good evening, students. Welcome back to the second semester of our continued contract accounting module. I hope you had some good rest and you come well prepared for the second semester topics that we have to do. By now, you should have received the new outcome plan and the roster with the weeks and the topics that we plan to complete during this 12-week stint to the end of the year, and then hopefully by then we would have completed our module uh, so that all of you can move on and graduate or continue your studies, whatever your preference might be. As you also know by now, we're going to continue with the online learning. So I'm going to be issuing a list of videos that will guide you through the learning process of each of these units. You can follow the module outcome plan to see what videos you need to watch when and what exercises you have to complete to stay on track to finish in the 12 weeks time slot that we are allowed to finish the financial year off with. Okay, so our first topic that we're going to discuss for the second semester is chapter 10 in your textbooks, page 237, if you want to follow with your green book, which is contract accounts. So this first video, I'm just quickly going to talk about what contract accounts is and why we do contract accounting. I'm going to show you a short example of how it works, and then it will be a breakdown for other further videos that you need to watch to be able to complete the contract accounts section. Okay, contract accounting is particularly important for all of you that might want to start their own businesses one day, or even if you work for a company, to understand that each contract can be accounted for on its own. So you can calculate the profit and loss not only for the company for all of the work and all of the contracts that they complete, but also you can calculate the profit and loss per contract. So you can see whether this contract has followed the pre-planned budget that you had in place, that you have more costs or expenses than you should have had, that you actually receive all the money you should have. What is the profit and loss per job or per contract that you do? So the contract accounting is for recording the workings, incomes, expenses, costs, and values of each contract that you do. So, for example, building a house for someone, or building a garage for someone, or doing paving at a shopping mall, or whatever it might be. We will name the contracts accordingly, and we'll see if we can calculate the costs applicable to that contract and the incomes applicable to that contract only, so we can calculate our profit per contract. The system is actually very simple. It's an easy system to follow, as you can see over here. Where we're going to record all of our expenses that you know by now, all of your incomes that you know by now, and then also adding the value of the assets that you use on the contract, and then when you send it back, the values will be added to the positive side of the contract. So taking all of those things into consideration to see how much money this contract has brought about for your business. Now, when we do this, there's two systems that can be used: the decentralized system and the centralized system. Now, why do we have this? Most building companies will have a head office that is situated somewhere, and then they use that to store all of their assets, the paving machines or whatever machines they need to use, trailers, vehicles, is stored at head office. And when it's needed, even some materials, cement and those types of things, and when it's needed for a specific contract, it gets sent from the head office to the actual site where it's needed. So you don't have to go and buy it all the time. You might have a build up a stock in the storeroom, so you can use the stock from head office, which then transfer to the site that you're currently busy doing your job or completing a contract, earning contract sales for the company. Now, decentralized system is normally for big companies and big contracts. So the contract might be over a year long term. It can almost be treated like a small company on its own, or a sub company of your big company. Like I said, that's mostly for long term and very expensive contracts. Then we also get the centralized system. The centralized system is where there's one head office, things happen over there, things are stored over there, and they transfer the assets that's needed, or the material that's needed to the different sites. That's the one that we get most of the time. So when we do this accounting processes for this course, you will see that we're only going to consider the centralized system where there's a head office, and then they give the items to each of the different contract sites. Wherever it's needed, it can be passed back and forth from contract to one contract to another contract, etc., etc. Okay, so the first thing that we need to understand when we're going to be working with the contract account is the certain items that either add value or decrease the value of the contract. So we're going to have a look at section 10.2 starting on page 238, moving on to page 239. Now when we talk about the contract account, it will be a normal general ledger account like you've been doing in the first semester, a normal account with a debit side and a credit side. We're going to get to the type of account it is and how it increases and decreases just now. I just first want to have a look at the 4 things that can influence the value of our contract account. Now the first thing that can influence the value of our contract account is any item that will add value to the contract. Now this is normally in the form of your assets. So a building that you have on site or the machinery that you use on site. Any asset, the vehicle, the buckies, whatever it might be, anything that adds value to your site, that will fall under the value category. We have to pay for those items. We don't just get them for free. So this will decrease the value of your contract, but obviously it adds value to your company. But because we pay for it, it will decrease the value of our contract. The second item is anything that causes income to the specific contract and eventually to your own business. So any money that you receive for the work that you've completed, the payments that you receive, the contract sales, when the work complete certificate is completed, for work in progress and completed work, those are things that add income to your business. So that will fall under the income category. Then we get our 2 payment options. One is for costs and one is expenses. What is the difference between cost and expenses? Costs is related to value. So that's the things we pay, the assets that we purchased, the material that we use on site, all those things, the labor that we pay for, those things are costs. That will obviously cost you money. It will decrease the value of your contract or lessen the profit, but they will be treated very similar to expenses. Now, why do we differentiate between the two? I don't want us to forget that we worked with assets and with expenses when we did the first semester. So that is where the difference is. Cost is related to assets, whereas expenses is related to the water and electricity you use on site, the wages that you pay on site, all the normal expenses that you dealt with that went to your expenses section under your income statement. Those are the expenses. They are both items that must be paid, so they will both decrease the value of the contract in the end. So those are the 4 types of accounts that we're going to be using, or we're going to have to look for when we try to complete the contract account. Okay, so the big question is, what type of account are we dealing with when we open up a contract account? And we're also going to look at what needs to be in the name of this contract account. So firstly, very importantly, a contract account, because it deals with profit and loss. The profit and loss, we know, belongs to the owner of the business, so therefore this account will be an owner's equity account. Now that is very important. Why is that very important? Because it's an owner's equity account, it will increase on the credit side and it will decrease on the debit side. Very important, so I'm just going to repeat that to spend some time over here. It's an owner's equity account because it deals with profit and loss. Profit and loss belongs to the owner of the business. And because it's an owner's equity account, very importantly, increase on the credit side. So in other words, any income that the business will receive, anything that causes money to flow back into the contract, to increase the value of the contract, will go on the credit side, and it decreases on the debit side. So any money that we have to pay for, any expenses or any costs when we buy assets, so when we pay the water electricity account or wages or salaries, all of those things will go to the debit side because it's an expense and decreases on that side for the contract account. because of it being owner's equity. So that's very important. The second thing, when we open this account, there's three things that we need to see in the name of this account. I'll show you now what a common name will look like, but let's just look at those three items. What is important? What needs to be in there? Normally, we use a sequence of numbers according to the year that we are busy with, and then the number of the contract for the year. So if I'm busy with 2020 and it's my 15th contract for the year, the number will be contract 2020/15. Or if I'm doing this in 2019, it's the 85th contract of the year, 2019/85. So that is how we number the contract. Secondly, we give a short description of what we're doing. So if you're building a garage, you'll have garage in the name. If you're building a house, you'll have house in the name. If it's paving, you have paving in the name. So you give a short description of what you're doing for this contract. But because you might build more than one house simultaneously if you've got a big team, or you might build quite a few houses during the year, we also need another little bit of detail. So normally if what I will do is I will just add in the name of the person I'm building this for. So that will be a nice thing to do, something descriptive that we know exactly what contract you're dealing with. And then lastly, we need to give the value of the contract. So when you budget or quote it for this contract, obviously there's a certain value, the amount you expect to earn at the end of this contract. That value will also be shown in the contract. So just to show you an example of what it will look like. If I was busy doing a contract over here, this is a short description. It's the 6th contract of 2020. I'm building a house. Might be more than the second or third or fourth house I'm doing for the year. So I'm giving it the short description, maybe the name of the person. If it was pavement for the macro complex, you'll put their macro, or anything that you know will be descriptive for the user to understand what it is. And then lastly, I put the value of the contract. So that is typical. The things that you need to gather, or the information or data that you need to gather before you can open your contract account. So number it, describe it to me, give me the value of the contract. Okay, so that's all the things that you need to know for opening the contract. Okay, on page 241 in your green books, there is a list of all the possible items that can affect your contract account. Remember what we said, owner's equity. So on the debit side, it will have all of the expenses. It will decrease on the debit side. So all the things that cost you money will go to the debit side. Here you see examples of all of those wages or salaries or materials, or when you transfer materials from the head office to your site, it now becomes your expense. That's an expense. The assets you transfer from your head office that's used on your site, that will become an expense. Repairs and maintenance, when you have plant hire, when you have subcontractors, there's a whole list. All of the expenses, all of those things will go to the debit side and decrease the value of your contract. On the credit side, we have all the things that will cause money to flow in, income. So when you've used building material from the head office, you haven't used all of it, you can transfer some bags of cement or material back to head office. You're now sending it back to head office, you're going to get the money for that. So now it's an income to you when you transfer it to that site. Or when you paid for an asset to be used, a paving machine or whatever it might be, you send it back to head office. You now get the credit for sending it back. It's like almost like selling it back to the head office. So therefore that now becomes an income. All the work that you've completed for contract sales, any work in progress that's still busy being done, but will cause money to flow in, all of those things will cause money to flow into your contract. Incomes for owner's equity account increases on the credit side, so it goes to the credit side. So that's very important. We'll talk about the profit and the loss later on. I'll do a video to show you how to calculate the profit or loss and how we deal with the profit and loss. Okay, the next thing I want to have a look at quickly is just to show you an example of how we deal with all of these transactions for the contract account. So I drew up just a small little account to show you, take out some important parts that you can use. I'll add this document on the Moodle site as well so you can refer back to it. Like I said, the name, the number of the contract, what year it's busy with, a short description, and then the value of the company, all your expenses on the debit side, anything that has to do with costs, things that you have to pay, the wages, paying for subcontractors, petrol for the buckies and vehicles on site when you use building materials, that's all your expenses. And then incomes when you send building material back to the head office, or when you send assets back to the head office or to other sites, you'll get the money for that. All the work you've done, the contract sales, the value of the work done, that's incomes. So very important when you look at the T account, debit side, left hand side, expenses and costs, credit side, the incomes. That's the most important part of this. If you have that basic knowledge, you can then complete most of the things that you need to complete for this contract account. Okay, I added a very important little note over here. Please remember that this account is simply used for internal transfers. So this account is only a transfer. I've already bought the material. I've already paid for the expense. I've already bought the asset. It's already been done. All I'm doing now is I'm transferring the value of that account internally into the specific contract where it will be used. We do this so we can calculate the profit and loss per contract and not for the company only as a whole. So the contract accounting is simply doing internal transfers. It's not a transaction. The transaction has been done already and it's only a transfer. Now, because it's only a transfer, no VAT will go to the contract account. So you'll see later when we do an example, when you do a contract account, the VAT will only go to the accounts that's used for payments. VAT will never appear in the contract account. So it's the excluding VAT amounts that goes to the contract. Okay, so just to give you a small little example of what I said over here, the internal transfer and the VAT story, let's have a look at a short little example. I said the business bought building material for 1,150 Rand. It's including VAT, that figure, and it's a cash transaction. This material was then transferred to the site for our contract. So the business bought the material, they've paid for the material, they have it in the storeroom. We now want to use it on our specific site, our specific contract. So we're going to now transfer this material to our contract. So let's look at that whole process and how it will happen. The first part you've now done plenty of times under Chapter 8, the general ledger entries. Firstly, you're going to calculate what the VAT portion is. So times by 15 over 115. And you'll see that the VAT is 150 Rand and that the excluding amount is then 1,000. Okay, so let's see how under normal circumstances how that entry will happen. I'm buying material, the excluding VAT amount is 1,000. So credit bank, money goes out of bank, so on the credit side. And debit building material, I didn't have material, I now have material in my storeroom, it increased. So there's the first entry. Then because it's a VAT transaction, credit bank with the VAT amount, and we debit VAT control with the VAT amount of 150. So that's the normal transaction you've now done plenty of times in Chapter 8 and 9 when we work with the VAT and the general ledger entry. So there's nothing new. So here comes the new part. We now want to send this material to our specific contract. Remember, it's only an internal transfer. So I'm not going to take the VAT. I simply want to take the value of the material from the material account to my specific contract. Why do I want to do that? Because I want to determine for this specific contract I'm working on, what was my costs for material. It's one of my expenses. And then later when I receive my money for my contract, I can see what the profit or loss was for the specific contract. So I want to make it contract specific. Material used on this contract must go to the specific contract account. Okay, so here's my material account. There's the 1,000 material I've purchased. I want to send it to the contract account. So I'm going to credit material with the 1,000, and if I credit material, I have to debit the contract account with the same 1,000. Why debit side of the contract account? I'm paying for this material. It's an expense for my specific contract to calculate. I don't get the material for free. It was purchased by head office. It's sitting in the storeroom. I now use it for my contract, so it's a cost for me, similar to what cost of sales was when you build a garage for a specific person. So expenses goes to the debit side of the contract account. So that's why it ends up on the debit side. Can you see? No VAT. So the VAT is just for the normal transaction when the purchase takes place. When I send it to my specific contract, it's only an internal transfer. So I only send the excluding amount from that account, wherever it's sitting, into the contract account. In this case, there's the material. I'm sending it, credit side of material, to the specific contract. It's now on site. It's part of my costs. I use it in the completion of the specific contract. Okay, so that was just a short example. There's more examples that you can go through in your own time in your notes from page 248 right through to page 2, I'll tell you now, to page 255. So from page 248 to page 255 is more examples like the one I've just shown you. Simply internal transfer, sending it from a certain account to the other account. If it's an expense for the contract account, you know it must end up on the debit side. If it's an income for the contract account, it must end up on the credit side. So go through those examples, simply internal transfers, so you'll see there's no VAT when it goes to the contract account. There is one new thing that we haven't dealt with yet, so I just want to quickly stop there, and that is called your overheads. Specifically overheads related to the head office. Now, why is that not a problem, but why is that something that we have to deal with when we deal with the contract accounts? When we work with a centralized system, like we've discussed earlier, we will have a head office where everything is run from. Now, that head office will have certain expenses, or like we call it, overhead expenses. For example, there might be a secretary that answers the phone. There might be specific advertising for the company as a whole that has to be done. Now, because that cannot be related to one contract only, we create the overhead account where all of these expenses that can't be related to a specific contract only goes, but it does influence the value of that contract. Why? All of the contracts rely on head office to deal with these things, to answer phones, the secretary salary, printing that must be done, advertising for the company that must be done. So it must influence the contract in some way. So what normally happens in this scenario is that they will have a total account or total expenses that goes to an overhead account. So there's an example of what an overhead appropriation account will look like. There's all of the head office expenses. So there was salaries and wages and stationery and the telephone account and water, electricity, everything that needs to be paid, expenses for the head office. This head office expense then has to be split between all of the specific contracts that the company has been working on. So you'll see there's contract 5 and contract 6 and contract 7. So there's 3 contracts that that this overheads will have an influence on. Now the question will always tell you what percentage each contract will have to deal with or have to carry. That normally depends on the size of the contracts. So all that will happen is all of this total added up to 14,380, and then whatever the percentage is, you'll calculate the percentage of that 14,380 and send it to the specific contract. So let's say 50% was for contract 5, as it is in this case, then 50% will be sent to contract 5. 30% or whatever the percentage might be sent to contract 6, and 20% sent to contract number 7. So you add up, get the total for overheads, split it according to the percentage, and send it to the specific contract. If we credit the overheads appropriation account, you'll see that obviously the contract accounts will be debited. There's the same amounts. Why debit? It's expenses, it's costs that the contract have to carry. We know all the costs and expenses goes to the debit side of the contract account. So it's simply taking the total, splitting it according to a percentage, and sending it to the specific contract that will carry that percentage, so it can be added into the costs of that contract. Okay, so that's in short what contract accounting is about and how we do it. Most important part for me, if you look at this little explanation document, all the expenses or costs goes to the debit side, all of the incomes go to the credit side. Remember, no VAT because it's only an internal transfer. So all of the amounts that goes into the contract account will be excluding VAT amounts. It's only a transfer, so simply take the amount excluding VAT from whatever account it belongs, send it to the specific contract it now relates to, and once we've done all of that, we should then at the end be able to determine whether the specific contract brought in money for the business, created the profit, or lost money for the business, created the loss. And that is the main purpose of doing this contract account. Okay, in the next few videos I'll show you how to deal with the profit, and then a term called retention, the provision for deficit account. I'm sure you've worked with it before, so I'll show you how to deal with all of that.